Okay, let's be real for a second. Trying to save for your kid's future can feel like you're staring at a giant wall of confusing options, right? It's a huge decision. Well, in this explainer, we're going to cut right through all that noise and get you the clarity you need to make the absolute best choice for your family.
So you obviously want to set your kid up for success, but the big question is, how? Do you go with an account that's laser-focused on education or something that's way more flexible? That's the core question we're tackling today, so let's meet the contenders. In the ring today, we've got two heavyweights of the savings world. In this corner, we have the 529 plan. I'm calling this one the education specialist. And in the other corner, the custodial account, the UTMA or UGMA, we'll call that one the flexible giver. They're both aiming for the same goal, but man, they have totally different ways of getting there. Before we jump into the head-to-head comparison, let's do a quick intro for each of them. It's super important to know exactly what we're talking about here. First up, the 529 plan. The best way to think about this is like a specialized tool, like a scalpel. It is designed for one job and one job only, paying for education. It's sponsored by states, it's absolutely packed with tax advantages, but it's all about that single focused goal. And then we have the UTMA or UGMA account. Now, if the 529 is a scalpel, this is more like a Swiss Army knife. It's a much broader way to transfer wealth to a minor. An adult manages it for a while, but, and this is the absolute game changer, once that kid becomes a legal adult, boom, full control of that money gets handed right over to them. And trust me, that changes everything. All right, ding ding, round one is all about flexibility. This really boils down to what can you actually spend this money on? And this is where you really start to see the different personalities of these two accounts. The 529, true to its specialist nature, is very precise. The money is for what they call qualified education expenses. This, of course, covers the big stuff like college tuition and fees, but it's also expanded over the years. Now it can cover K-12 tuition, some student loan payments, and even apprenticeship programs. But here's the catch, and it's a big one. You step outside those lines, you use it for something else, and you're going to get hit with income tax plus a 10% penalty on the earnings. Ouch. Now, on the complete other side of the spectrum, the UTMA is all about freedom. While the child is still a minor, the funds just have to be used for their general benefit. But the second they take control as an adult, that money is theirs to use for absolutely anything. A car, a down payment on a house, a trip around the world, you name it. There are literally zero restrictions. Okay, on to round two, control. And listen up, because this might be the single biggest, most important difference between these accounts. For a lot of families, this is the one that really makes the decision for them. I mean, just look at this. It's night and day. With a 529 plan, the account owner, that's usually the parent, keeps control forever, indefinitely. If your first child decides not to go to college, no big deal. You can just change the beneficiary on the account to a sibling, a cousin, even yourself. But with a UTMA, that's an irrevocable gift. The money legally belongs to the child. The minute you put it in, it's theirs. And when they hit the age of majority, that's it. It's theirs, period. There are no takebacks. And this really drives the point home. This is the reality of that transfer of control. You might have saved that money for years with college tuition in mind, but if your 21-year-old decides they'd rather have a new sports car, there's not a single thing you can do about it. It requires a level of trust that you just have to be prepared for. Okay, let's move on to round three, taxes. This is where the numbers get really, really interesting. And frankly, it's where the 529 plan was designed to absolutely shine. The way the government treats the earnings in these accounts is fundamentally different. The 529 plan has this amazing thing that people call a triple tax advantage. Here's what that means. First, your earnings grow 100% tax deferred. Second, your withdrawals for qualified education expenses are federally tax-free. And third, on top of all that, many states will give you a state tax deduction or credit just for contributing. It's incredible. Plus, there's a great new rule that acts as a safety net. If there's money left over, you can now roll up to $35,000 into a Roth IRA for the beneficiary. How great is that?
Now, a UTMA doesn't have those special shields. Its earnings are subject to something called the Kiddie tax. Basically, the first small chunk of investment income each year is tax-free. The next chunk is taxed at the child's lower rate. But once the account starts generating more than a couple $1,000s in earnings, that income gets taxed at the parent's much higher tax rate. So yeah, it's definitely not the tax-free haven a 529 is.
And that brings us to our final and maybe the most critical round, the impact on financial aid. If you think there's any chance your child might need need-based aid for college, this is something you absolutely, positively cannot ignore. So let's just pose the question directly. When you fill out that FAFSA form, which one of these accounts is going to hurt your chances for getting financial aid more? The answer might just shock you.
For a 529 plan, the FAFSA considers it a parental asset because, well, the parent owns the account. This means it's assessed at a maximum rate of just 5.64%. It's a relatively small dent in your potential aid.
But now, look at the UTMA. Because that money legally belongs to the child, it's considered a student asset, and student assets are assessed at a whopping 20%. The difference is just enormous.
This chart just puts it all into perspective, but let's make it concrete. For every $10,000 you have saved, a UTMA account could reduce your child's financial aid eligibility by $2,000. That same $10,000 in a 529 plan, it would only reduce it by about $564. We're talking about a massive, massive difference here.
So, after 4 rounds, where do we land? It's not about which account is better overall. It's really about which one is the champion for your specific goals. Let's break down the final verdict.
Here's your final cheat sheet. If your number one goal is dedicated, tax-free savings for education, where you keep control and you protect financial aid eligibility, the 529 plan is your clear winner. It's not even close. But if you value ultimate flexibility and you're preparing your child for financial independence with a gift that they will control, then the UTMA is your contender.
But hey, remember, this doesn't have to be an either-or decision. A really powerful strategy can be to use both. You can fund a 529 for all the core college costs to get all those great tax and financial aid benefits, and also have a separate UTMA for other big life goals that fall outside of what a 529 can cover, like a first car or a down payment.
So we end where we began, but hopefully with a lot more clarity now. The choice really boils down to this one question. Are you laser-focused on optimizing every dollar for education costs, or are you looking to provide a flexible financial springboard for your child to use however they see fit? Your answer to that is what's going to tell you which path is right for you.